Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host Neil Gabe, and today I want to talk about the Residential Tenancy Act that has recently passed Parliament. And if you do have a standard investment property, the changes that are coming, I'll explain the changes that are coming for you, and also want to show you why investing in a HMO that does not fall under the Residential Tenancy Act is a better outcome for yourself, for the people that live there, and for everybody involved. Because I've been beating my HMO drum for quite a while now, talking about how good this is, and the reason that it is so good is for so many reasons. But for you as an investor, you want to invest your hard-earned money into assets that appreciate in value and produce a return, so that you can live a life that you dream of, that you want, that you need. Because you cannot create wealth in this country by just saving money. Inflation will erode the value of your dollar, and $1 million today will not be the same as $1 million in 10 years and in 20 years as well. So you need to invest in assets that produce cash flow, so you can live off the cash flow, also known as the golden goose that lays golden eggs. And for the team the other day, with interest rates sitting where they're sitting at the minute, and with construction prices sitting where they're sitting at the minute, for the team members that have been with me for 2 years plus now, which is probably 50% of my team, they are saying that the HMO doesn't look as attractive at the minute, because we had the luxury of 3%, 3.5% interest rates, which were interest only, and it made the HMO look absolutely fantastic, to the fact where some of our clients were achieving $40,000, $50,000 a year net cash flow after all expenses. And right now, with interest rates sitting at 7% in the HMO lending space, that cash flow is sitting around $18,000 a year, which is still good, right? When we first got into the HMOs, the first HMO I did was $15,000 a year cash flow positive, and I thought that was incredible. And it is incredible, and it was incredible because it was the first one that we'd done, right? So what I did for my team is I created two feasibilities side by side, and I created a typical HMO new build, and I created a typical 4-bedroom, 2-bathroom new build in the exact same suburb. So the land price was exactly the same, so they get exactly the same capital growth. The only difference is I reduced the construction price on the standard 4x2 from $575,000, which is what a 6x6 single story HMO costs on average, to $400,000 for a standard 4x2. I then reduced the interest rate from 7% down to 6%, because we can get standard interest rates from the normal lenders. We don't have to go through the HMO lenders. And then I reduced the number of rooms down from 6 down to 1, because you only have one income from a standard rental property, and I put that rent at $600 per week compared to 6 rooms at $350 a week. Now, the difference in the outcome between investing in the exact same suburb and the exact same street was $37,000 per year difference for the exact same street, exact same house. We've just built the house a little bit differently. It's cost a little bit more to do it, but your money's working a lot harder for you, right? Remember, income is the outcome that we want to generate. And if you look at any of these other wealth specialists or property investment specialists, they all want you to build a foundation of high growth investment properties, but equity doesn't pay the bills, right? Cash flow pays the bills. So when you get to a certain size portfolio, they say, let's sell down some of the old crappy properties that we've seen some capital growth on, and let's put that into commercial. Let's put this into something that provides cash flow, which a lot of them are starting to look at HMO, rooming house, co-living right now. and the money is starting to flow from the standard investment stock into this market now. Why? Because cash flow is king. We invest so that the cash flow that our portfolio generates can replace our income when we retire, and it means we can retire early, and it means we can quit the job that we don't like working in, and we can work somewhere else that fills our cup but doesn't fill our bank account as much as what our old job did. So $37,000 difference, same street. Yes, it's not producing 35, 40 grand a year cash flow like it used to, but when interest rates come back down, that cash flow figure will continue to increase, and the HMO is here to stay. But anyway, back to the Residential Tenancy Act that's passed Parliament. There's some things that you as an investor need to be aware of. This is another reason why I believe HMO is better than standard investment property, because we don't fall under the Residential Tenancy Act. So they have introduced, and I've got this little document in front of me just to keep me refreshed on it, because I'm not full hog on the Residential Tenancy Act. Why? Because we don't need to be, because we don't really use it a great deal. So the things that are coming into play, they can now, the lessor or the owner of the property can now only increase rent once every 12 months, even if a new lease is entered into during that time. It's not a bad thing, I don't think. Why can't an investor wait 12 months for another rent increase? It's not too bad. But yeah, set your rent, wait 12 months, go back, increase it. Generally in a Residential Tenancy Act agreement, there's a percentage in there that they increase the rent by every year as well. So they can't go from like $500 to $1,000 a week. It should be in increments of what's noted in the document, in the agreement that you signed. They've also introduced prohibition of rent bidding, which means that they can't advertise a property for a certain amount per week and then entice the person that wants to rent the property to bid higher. And this is something that the property managers need to be aware of, because if they step outside of this, then there could be some serious ramifications for them. They are now also allowing pets into these properties without your say so, essentially. Which again, I don't think is a bad thing. You know, we've had pets. I've had dogs all my life. I absolutely love animals. The joy and the love that they bring to a house is incredible. And a lot of people, especially the lone people out there, the people that are on their own, they seek comforts and guidance and love from a pet, whether it's a cat or a dog or anything. So I don't think it's a bad thing, but I think still giving the investor the opportunity to actually say whether I do want that dog in there or not, or I do want that cat in there or not, I think that's only fair. We are investing hundreds of thousands of our hard-earned dollars into these properties. There's going to be a pet bond that's going to be taken. It's not too bad. And you have 14 days to approve or refuse it, but your refusal needs to be in written refusal, and it needs to be you can only refuse it on the basis it would violate a written law, local law, or scheme bylaw. So if it doesn't break any laws, then that animal is coming into your house. Now we've all for the last 15 years we've had 2 Chihuahuas, and they're the smallest dogs on the planet. And yes, I get it, I'm 6 foot, I'm 90 kilos, and me walking 2 Chihuahuas down the street is quite comical. I'm sure people do get some fun out of it. But beautiful little dogs, but at the same time they don't make a lot of mess. Once upon a time, a few years ago, we looked after one of our friends' dogs. She brought a staffy round for us. Wow. Wow. When this thing drinks water, water goes all over the floor. When it eats food, food goes all over the place. When it goes to the toilet, it's everywhere. So I believe that if somebody has a big dog, and going back to the dog thing, I love animals altogether, but if somebody has a big dog and you as an investor don't want that dog in your house because you know what they're going to be like and there's potential for damage, I think you should be able to say no. Keen to hear your thoughts on that one. If you think I'm wrong, send me a message, let me know. This other big one that is going in now is minor modifications. So now, if a tenant submits the application, the modification application form, you now have 14 days to approve the application or refuse it on the basis that the property is heritage listed or that the modification would disturb asbestos, is illegal, or would violate a written law, local law, or scheme bylaw. So you can't actually now say you do not want minor modifications to your properties. Now, I dropped this into our Facebook group, the Perth HMO and NDIS Facebook group. And the first person that commented said, this is why I stopped investing in property years ago. It's all heavily weighted inside of the tenant and the investor doesn't get looked after at all. And I kind of understand where he's coming from there. But, you know, there's still opportunities for people to rent out and do the right thing. HMO is one of them. The bond disposal process is something being put in place there so that if one person doesn't approve the bond or refuses the bond, it can go to the commission. If the commission can take over it, I won't go into that one too much. Yeah, pets, modifications, etc., etc. Now, let's look at the HMO side of things. Rent increases every 12 months. We have 6-month agreements with our housemates who live in our properties. Again, we're not under the Residential Tenancy Act, so if we believe that a room rate can be increased in 6 months' time, then we'll increase it in 6 months' time. We are aware that we are providing affordable accommodation to the market. We've had some of our clients want to hike the room prices up, and we've had to have a chat with them. Like, remember, guys, this is supposed to be affordable. It's not a gravy train that we're going to absolutely put people under pressure to live in these properties, because we would rather give them a fair rent and have them stay in the property for longer rather than crank it right up and then they move out to 6 month or 12 month because they can't afford to live there. Rent bidding doesn't really happen with our property management team. The price is advertised on the market. If people come through, and we are seeing in some properties, 5, 6, 7 people turning up to view one room at the minute. The room rate is a room rate. It's the first person. Well, not the first person. We send the link out to everybody to apply for the property, and then we'll just pick the best property out, the best applicant out of that one as well, without background checks, etc., etc. Nobody in a HMO really wants to make a minor modification. They're already set up to have people live in these properties the way that we expect them to live in them. So there's no real minor modifications required. This is what I've missed. I've missed the can't even say it. Put me teeth in, Mr. Gibb. Retaliatory action taken by lessor. So new provisions enabling a tenant to seek remedy or compensation by a court if they believe the lessor has taken retaliatory action after they exercise their right as a tenant. So if a tenant asks for something which they deem to have access to under the Residential Tenancy Act, and you as the lessor do not give them that, and then or give them it begrudgingly and then cancel their lease agreement in the future, then that lessor can take action now because they're exercising their right as a tenant. So there's some of the things that are coming in for the residential tenancy market. I do not want you to think this is all doom and gloom, because it's not, because the Perth market right now is incredibly buoyant and prices are still flying up. There's still 10, 20, 30 people at home opens. Real estate agents are still saying that they're seeing opening offers 10 to 20% above what the asking price is on the market for purchasing properties, which is what's driving these prices up, right? REWA released a market forecast update a couple of weeks back, and they said that a 20% increase in the Perth median house price sale from January until the end of the year is a very real possibility, according to the 2024 property market quarterly update. REWA CEO Kath Hart said the rate of house price sale growth has accelerated in the last 2 quarters. Updated figures from December show 4.3% growth over the quarter, and preliminary figures for March are sitting at 4.2%. We can expect that to increase as more properties settle, she said. The median house price sale has increased 13.6% over 12 months to March to a record $625,000. And if the market continues to grow as it has been, 20% growth is achievable between January and the end of 2024. So let's just do quick maths on this. If you have $1 million property and you put 20% deposit down on that, that's $200,000, and your $1 million property increases in value by 20%, how much have you made? People think you've made 20%, but you've actually made 100% cash on cash return because your property's increased by $200,000 and you put $200,000 down on the property. So you've made $100,000 on you've made 100% cash on cash return on the $200,000 that you invested in that deal. This is why I think real estate is just the greatest asset on the planet, and you can leverage that, right? The banks will see the value in that 20% growth as long as there's comparable sales in the area. You can go back to the bank and say, Mr. Bank Manager, I would like to refinance my property. I would like to take some of that equity out and I want to buy another property. And the banks are very, very bullish with property in the minute. And as long as you've got the income, borrowing capacity to service that loan, there's a good possibility that you can redraw and put that money into another property, and that's how you build wealth. Miss Hart said current market conditions were underpinning the expectations of ongoing price growth as well as price trends. We look at a range of figures when preparing our forecasts, and the data suggests the significant imbalance between supply and demand will remain in 2024, maintaining the upward pressure on prices, she said. We have a very high demand fueled by extremely strong population growth, and this is expected to continue. We are awaiting the Cook government's latest population forecast in the upcoming May state budget, which should be out very, very soon. And in addition, some of the new housing remains limited. In addition, supply of new housing remains limited, which continues to focus demand on established homes. Building competition have been increasing. Building completions have been increasing, which is fantastic news, but we're still not building enough new homes to meet the demand for WA's growing population. Supply and demand are the basic fundamentals of any market which drive growth. Too much supply, not enough demand means price growth stagnates and drops. Lots of demand and not enough supply means people start clambering over each other to buy property, which is what we're seeing right now, and that increases property values. Detached houses make up the majority of the new building activity, with apartment construction limited to luxury projects, which is limiting the provision of affordable and diverse housing options. While completions are up, new home commencements have been declining. New home approvals have only just started to trend upwards. These figures suggest new home supply will remain below the state's need for some time. Ms. Hart said the strength of the WA economy was also supporting price growth. God, I cannot talk today. Sorry, guys. I am struggling with my words. Unemployment is low, which boosts consumer confidence as well as people's ability to buy a home and manage a mortgage, he said. The Reserve Bank's new meeting schedule has also given people a break from monthly concerns over rate rises, and some commentators are forecasting a rate cut in the medium term, which would also support buying power in Western Australia. Ms. Hart said there would need to be a significant change to the current conditions to slow Perth dwelling price growth. We continue to watch the data and update our forecast accordingly, she said. The median unit sale price also improved strongly over the March 2024 quarter, recording a 3.4% growth to reach $425,000. This was 6.3% higher than March 2023. By comparison, units recorded 2.8% growth during the December quarter and 1.5% over 2023. The median unit sale price remains below the record of $450,000 set in 2014. So there's still a little bit of growth potentially in unit sales. The only problem is no one's building them at the minute because it's really hard to make them stack up. And like Kath said earlier, we're only seeing apartments being built in the luxury areas because it really costs a very similar amount to build 25 apartments, whether you build them in Armadale or whether you build them in Applecross. The finishes are obviously going to change to meet the market, but once you start going floor on top of floor on top of floor on top of floor and going vertical, the price isn't going to change too much, but the end sale price between Armadale and Applecross will be absolutely chalk and cheese. In the Perth rental market, records continue to be set in the rental market in the first quarter of the year. The median dwelling rent hit a new high of $650 per week at the end of March, up 8.3% from $600 at the end of December and 18.2% from the $550 per week recorded at the end of March 2023. So we're essentially getting an extra $100 a week compared to last year. The median weekly house rent price also set a new record, rising 4.8% over the quarter and 18.2% over the year to $650 per week. The median unit rent price rose 5.3% from the end of December and 20% from the end of 2023 to $600 per week, which is another record. Rental listings remained low, sitting below 2,000 over the quarter. The vacancy rate dropped to a new record low of 0.4% at the end of March. 0.4% at the end of March. Just staggering. Staggering that so many people are moving to the country, yet there's like under 2,000 properties available to rent on the market. The rental market is affected by the same conditions as the sales market. Strong population growth and low supply, which remained upward pressure on rent, she said. Miss Hart said there were signs demand was moderating in some sectors of the market. Some agents are reporting a slowdown in demand at the higher end of the market. However, it remains strong in the more affordable price brackets. Now, why do we think that's happening? Probably because money's so expensive right now and people don't have the borrowing capacity to be able to borrow $1 million, but also pay back $1 million. And affordable accommodation always wins, which is why the HMO is a winner in an up market and a down market, because affordable accommodation never goes out of fashion. Everybody needs affordable accommodation. So there you go, guys. I won't go on too much about that, but quick update on the Residential Tenancy Act changes, quick visual or a quick soundbite on the difference between a standard residential property compared to a HMO, and a little bit of market blurb from the one and only Kath Hart from REWA. So thank you very much for your time, guys. Join us again next week. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.